Woo! It's been a while since we did episode 9. Well, last time we did episode 8. Welcome in, everybody. Let's go ahead. I found great videos created by the professor himself, George. Greg. We're gonna watch him. He's gonna do a great job. He does a fantastic job explaining. I highly recommend you guys subscribe to his YouTube channel. We're gonna go into Zoltan Pozart's thing that we've done. I started at the end of November when he did the Odd Lots podcast. So I want to continue it on with his view. He explains it way better than I could. That's how I want to get into his videos. Right. Let's get into it. You guys will learn why is it that I'm contrarian, why is it that I'm still playing gold silver, and why I'm long energies too for a bit, long enough for like 2 years. It should go up, all due to dollar weakness. So here we go. Let's jump into it.
Three main markets we need to understand: the repo market, the bond market, and the FX swap market. The repo market is basically a pawn shop for the financial system. There are financial institutions, call it Fannie and Freddie, a money market fund, hedge fund, or other banks, and they need liquidity. They need some cash overnight or for a specific time frame, but all they have is collateral, usually treasuries. So they'll go into the repo market, say, hey guys, we need some money overnight. And a lot of times it's these primary dealers. These are the big banks under the Fed's umbrella, such as Goldman Sachs, Citi, JP Morgan. They have their reserves and excess reserves held with the Fed. So if they've got some excess reserves, they'll say, okay, well, Mr. Financial Institution, we'll go ahead and give you that money overnight or for however long you need it. Maybe it's a 14-day term loan or a 30-day term loan. And then the financial institution will give the primary dealer collateral, which is that treasury. And then at the end of the repo, at the end of that term, they'll go ahead and swap. The financial institution will get the treasury back, and they'll give them the money that they borrowed with a little bit extra, so the primary dealer has a profit. That's what incentivizes them to lend into the repo market in the first place.
Okay, the only thing he didn't touch on is how big the market got. After the crisis happened, he'll explain how Zoltan got involved, like when he came into the Fed. They bring up the articles, same ones that I read. But it was Zoltan in the All Lost podcast said that these things got massive. The financial institutions, hedge funds, a lot of them started coming in by the big dealers, the big banks, sponsoring them. So the repo market is giant now. It's a lot bigger than it was back in 08.
Next, we've got the bond market. That's where treasuries are traded back and forth. Then it's the FX swaps market, which sounds fancy, but it's really quite easy. We've got Corporation A, which is American Corp. Corporation I, Italian Corp. Italian Corp needs to borrow some money in dollars. American Corp needs to borrow some money in euros. But if they do that, they're going to get charged a pretty high interest rate. So let's say both of them need the equivalent of right around $50 million. Italian Corp would borrow that money in euros. American Corp would borrow that money in dollars, a lot of times from the primary dealer banks. And then they would just go ahead and swap. It gives them a hedge so they have less currency risk and they get it at a lower interest rate. Now that we understand the basics, let's go directly to Zoltan's article and understand the details of his argument.
He does a great job explaining this.
Really interesting. The Fed's liquidity operations, in other words, repo madness, have not been sufficient to relax the constraints banks will face in the upcoming year-end term. That's just the end of the year. Reserves are still insufficient. There are no true, quote-unquote, excess reserves. The large U.S. banks' G-SIB scores, and we'll go over that in a moment, are shaping up to be a severe binding constraint heading into the year-end term. We have never had a year-end without a comfortable buffer of excess reserves, or when G-SIB scores could force most U.S. banks to turn off market making. What Zoltan is saying specifically is that at the end of the calendar year, there are always constraints on liquidity, meaning a lot more demands for cash. Editor, let's pull up the chart of the repo rate going back to last year at this time, and you'll see there's a noticeable spike. Usually there are plenty of excess reserves to handle that, but this year Zoltan thinks there are no excess reserves to act as a buffer. He comes to this conclusion for a few different reasons. Number one, because the government has been doing so much deficit spending, that creates additional supply of bonds.
Okay, and get this. This video was done in December 17th. So it's a little old, but the information is still great. The other thing is, they just, Trump just signed this into bill. Signed the bill into law.
The primary dealers are the market makers, so they are required to buy those additional bonds. The Fed is also doing quantitative tightening, or QT. That's where they're taking the treasuries from their balance sheet and selling them into the market as well, generally to these primary dealers.
Let's stop doing quantitative tightening.
Primary dealers get the money to buy all of these treasuries that are raining down on them.
Stop September.
They're required to purchase from their reserves that they have with the Fed. That's why Zoltan thinks that the excess reserves are so limited. To make matters even worse, he talks about the GSIB, which is the Regulation Global Systemically Important Banks. The regulators come in and give the banks a score. Based on that score, they have specific capital requirements that they must meet. So
which was that was in the Allah's podcast. That's when they were talking about like, oh, your parents are coming, clean up the room. You already know they're coming, so you gotta meet those scores. That's the exam that I was talking about. You failed it, you know what's on the test, so you know, because you've seen the test already, you've done it. You should pass it the second time around.
At the same time where they're depleting their reserves, the regulators are requiring them to have more reserves. Zoltan thinks this is why the Fed has come in and done repo madness. That's where they inject the money into the repo market, because the interest rates spike because there's not enough liquidity, or there's not enough cash to satisfy that demand. Usually these primary dealers provide a lot of that liquidity to the repo market, and because they're getting squeezed over here, that's why Zoltan thinks that these primary dealers aren't going to be there to provide the liquidity at the end of the year.
Yeah, the buffer.
Next, Zoltan says the FX swap market shows implied yields that don't imply a bad year-end turn. Yet, it is the market most exposed to liquidity and balance sheet constraints. What Zoltan is saying there is the FX swap market is the most sensitive to the lack of cash in the repo market, or the primary dealers not having enough cash on their balance sheet. So let's say the end of the year interest rates in this market are 6%. Zoltan says that's typical, that's normal. And if this market really understood what was going on with his explanation, those interest rates would be at 10%. In other words, they'd be a lot higher than the 6% that they're showing. Zoltan is saying that this means that nobody in this ecosystem understands the problems that he thinks he sees so clearly. The apparent lack of concern may come from last year's benign experience, and that repo rates have been trading normally since the September blowout. And that's when the Fed started repo madness. But these facts are less relevant than they seem. Last December, U.S. banks had plenty of excess reserves and had no GSIB constraints. And that liquidity operations have kept a lid on repo rates since September doesn't mean they will be effective as balance sheets bind going into year end. So Zoltan thinks that because the Fed came in with repo madness and calmed the market down, and because last year we went through this cash squeeze where we had a liquidity bottleneck and nothing happened, the market thinks that everything is A-okay and they're just whistling swap market becoming unglued is the biggest risk for RV hedge funds, relative value hedge funds' assumption that they will have balance sheet to fund their bond basis trades around the year-end turn and not to punitive rates, if at all. They've lined up forward settling sponsored repo trades to lock up balance sheet for the turn. But they don't know the rates they'll have to pay on these trades or if banks will be able to fund these trades. And they are missing the incentives at play.
Okay, real quickly, let's talk about Warren Buffett. It's real fast. Warren Buffett has like over $120 billion on hand. He hasn't invested. It showed up on my Twitter feed. I sent a reply to it, just saying, he probably understands what's going on in the repo market. Probably that's probably the reason why he's not investing. Based on that, and I explained that the repo market got bigger because of all the sponsorships that the primary dealers did, bringing all these people, hedge funds, other financial institutions. Sorry, I don't know why I had difficulty, but it's gotten bigger. So Warren Buffett knows this. So he has cash on hand because he sees everything's overvalued. The more money you're printing, the higher the valuations go because more money's there, but it causes inflation.
All right. If you're asking yourself right now, what the did that guy just say? I'm going to explain it to you right now. Don't worry about it. All he's saying is at the end of the year, the hedge funds have this big gamble that they want to pull off. And to do that, they've got to go into the FX swap market. Right now, they're prepared to pay 6%, but if the interest rates go up to 10%, they're going to have to pay more for those bets. Where's that money going to come from? One of two places. Either their balance sheet, got a little balance sheet right here with assets and liabilities, they're going to have to draw down more cash, or they're going to have to go to the primary dealer and borrow it from them. The problem is that right now, like we said earlier, the primary dealer doesn't have any excess reserves to lend. Zoltan goes on to say, dealers selling forward settling sponsored repos over the term have an incentive to introduce an imbalance in collateral markets to maximize the value of whatever excess reserves their bank operating subsidiary has left to lend over the term. Whew! He is really trying to sound smart right here, isn't he, guys? In turn, the dealers' hedge funds expect to stand between them and the Fed to bridge the above imbalance may not be there for them if the FX swap market becomes unglued and offers better yields than the GC repos or general collateral repos. In other words, if the interest rates in the FX swap market go up to 10%, anyone with liquidity in this ecosystem is going to look at that juicy 10% and then look at this measly 2% in the repo market and say, hell no, I'm going right to that FX swap market and I'm going to get me some of this 10%.
Of course, why not? Higher yield. Everybody's been going after higher yield. It comes to common sense, really.
The Fed will be doing QE4 by year end. The safest asset, U.S. Treasuries, is funded by RV hedge funds on the margin. And the FX swap market pulls balance sheet and funding away from them. The safest assets will go on sale. Treasury yields can spike into year end, and the Fed will have to shift from buying bills to buying what's on sale.
Coupons. Interest rate.
And this is where his esoteric.
And that was the play that I was doing this year end this week.
And now this gets really complex, guys.
But he explains it way better than I could.
I really need you to concentrate. Follow me on this one. What Zoltan is saying is there's going to be a lot of treasuries for sale and no buyers. So the Federal Reserve is going to have to come in and buy those treasuries. In other words, QE.
Mm-hmm.
I think Zoltan needs to hire my 5th grade nephew to write his next report. Step number 2, Zoltan Pozar versus Jeff Snyder. When Zoltan came out with this report, Jeff went on the Macro Voices podcast.
Macro Voices podcast is great, guys.
Major
Highly recommend it.
With what Zoltan was saying. So this gives you a completely different angle on this whole repo market situation. Snyder had four main disagreements. First and foremost, over the last few years, Zoltan has said that these dealers need to hold the treasuries. So just as a reminder, the primary dealer banks, they have to buy those treasuries from the federal government. They are the market maker. But Zoltan was saying that they need to hold them, which creates a liquidity restriction or less cash in the system. Snyder says that's flat out not true, because although they have to buy them, they can sell them just as soon as they buy them. And they're actually incentivized to do so, because they can flip those T-bills, make a quick profit, take that liquidity, inject it right back into the repo market, and make the spread. So there's no need for them to hold these on their books. Zoltan now has changed his tune, which disappoints Jeff Snyder quite a bit. You can tell how frustrated he gets.
Because Zoltan makes a great point here.
And he's now saying that, yeah, they can go ahead and sell those treasuries. They don't have to keep them on their books, but they're choosing to keep them on their books now because they're trying to front run QE4. Well, what does that mean? What Zoltan's saying is that these banks know that the Fed is at some point in time going to have to come in and start buying long-term treasuries again. It's just a foregone conclusion. The banks know that if the Fed comes into the bond market, that's going to create artificial demand for those treasuries. Well, if there's more demand for those treasuries, that means the price of the treasuries will go up. So the banks are holding these treasuries because they think the Fed.
It's like everything else. Everything's priced in. They're pricing it in.
Front running is. Snyder's second argument is that the front running just isn't possible because it would be a really
like Apple's overdone, dude. It's way overdone now.
Say that it's stupid because if you look at a chart of QE, editor, go ahead and pull that up right now, and you layer over another chart of the treasury price. And keep in mind, there's an inverse relationship between the treasury prices and the interest rates, or the yield. So when the yield goes down, the prices go up. If what Zoltan was saying were true, you'd expect to see a correlation between the amount of quantitative easing done and the interest rates of treasuries, like the 10-year, going down. Because you don't see that, Jeff is saying that can't be a legitimate reason for why the banks are holding on.
Subscribe to the man's channel.
Snyder's third disagreement is every point that Zoltan is making is completely predictable. Whether it's the GSIB, taxes, quantitative tightening, increased deficit spending by the government, none of this has come out of the blue. Since it's predictable, why hasn't the Fed taken the measures necessary to plug those holes in the market? The bottom line, and this is disagreement number 4, is that there isn't a calendar risk. So Zoltan is saying that all these things that happen at the end of the year creates this risk. It's a date and time. Snyder is saying that is nonsense. It's not calendar risk that we should worry about. It is systemic risk.
Because they know each other. Banks know each other.
Banks are holding on to treasuries not because they're trying to front run the market, but they're holding on to treasuries because there's systemic risks in the banking system that they can see and we cannot see.
Let's be realistic. Banks are going to do both.
Do I agree with Zoltan Pozar?
That's the thing.
Jeff Snyder. Actually,
we're going to do one more video of his.
Both, but for different reasons. Let me explain. I do think we'll see QE4 very soon. I don't know if it'll happen at the beginning of the year, but I think it will. In 2020, we'll be seeing what the
I hope so. I have a bunch of freaking calls in February.
On the repo market, which every other sane human being on the planet Earth would define as QE4. And the difference between those two things is that right now, the Fed is buying short-term T-bills, and technically, by their definition, they have to buy long-term treasuries in order for it to be considered QE. I also agree with Jeff Snyder that there's systemic risks in the system, and that's why the primary dealers are holding on to those treasuries. They look at Deutsche Bank, Santander, HSBC, and say, no way are we lending them money
HSBC is still dealing with the Hong Kong
for a
crisis.
14-day term, 48-day term, whatever it is. Going back to Zoltan, I think the banks could be front-running the market.
Yeah, why not?
I don't think they're front-running the Fed. I think that because of this systemic risk that they see that Snyder is talking about, they could be front-running a crisis. Why would they do that? Because the safe haven asset, as the world sees it, right or wrong, right now, are U.S. Treasuries. So if they see a crisis coming in the future as a result of this systemic risk that they can see and no one else can, they're going to hold those treasuries, because when that crisis happens, the price of these treasuries will go through the roof.
Yep.
For more information like this,
Right, so I'm telling you, that video it's top of the line, dude. It makes it so much easier. Everybody I told to watch it has watched it and understands what I'm talking about a lot better now. All right, we're gonna go to watch this one, and then we're gonna get into little things I want to touch on. Wrap it up.
Zoltan Pozar, we remember the report he came out with December 9th, outlining how next week could be the financial system's version of Y2K. But why should we listen to Zoltan? Why does his opinion matter? For that, let's go right to a recent Bloomberg article that was submitted to me by my buddy Jason Burke with Wall Street for Main Street. If you haven't checked out his YouTube channel, make sure you do so.
It's a great channel too.
In 2008, shortly before the collapse of Lehman Brothers, Zoltan went to work for the Federal Reserve Bank of New York, where he became known for creating a map of the financial system that included repo and shadow banks outside traditional lending. Pozar had such a deep understanding of the financial system that a poster version was pinned up in the New York Fed's briefing room. Pozar encouraged coworkers to stop by and review it, saying otherwise they'd only be looking at 10%.
Dude, how amazing is that? How well this man knows his stuff.
He then went on to work at the U.S. Treasury Department and landed a job at Credit Suisse in 2015, where he began writing research notes about the mechanics of the Fed's coming interest rate hike. So basically, Zoltan was the guy at the New York Fed that was in charge of teaching everyone how the financial system actually works. That's why when he speaks, the markets listen. Going back to the report that he did on December 9th, let's review that quickly. Zoltan claimed that the financial institutions and the primary dealers that are involved in this financial ecosystem, along with the Fed, would start selling treasuries. They would do this because they want to generate the cash to take advantage of higher yields in other markets, such as the FX.
Which they would.
This would increase the yields on the bonds or the treasuries, because more selling would make the price of those bonds go down. If the price of the bonds go down, then the yields go up because of that inverse relationship. The Fed can't have this because they know that would really crash financial markets like the stock market. So they would have to come in with QE4, print money, and go into the bond market to buy all those bonds that the primary dealers and the financial institutions are selling. What did the Fed do? Well, they saw Zoltan's report, and you can put two and two together. They won't admit this, but if that's the guy.
Everyone said this when it happened.
2008 was teaching them about how the financial system works, and that guy came out with a report saying they're basically screwed December 9th, it would come as no surprise that the Fed came out with their own policy change just 3 days later, out of pure coincidence, in which they said that they were going to inject more money into the repo market.
Zoltan had an interview and he just simply stated that, I don't mind being wrong, proven wrong, when I feel like my report helped them do the right thing, which is put more liquidity into the market. He had on Bloomberg.
Time that Zoltan predicted they would have big problems at year end. And keep in mind, the Fed can't admit confidence, that would destroy confidence. So
fiat money, confidence. You lose confidence in the US dollar. That's it.
they have to
Fiat.
covertly go into the
There's
repo
nothing there.
market and inject more liquidity in hopes that the primary dealers and the financial institutions won't sell all of those treasuries to come up with the cash they need. And instead, they'll go into the repo market to borrow that cash, then take that cash and invest it elsewhere and get that big return at the end of the year. In their policy response change that they came out with on December 12th, after Zoltan's report on December 9th, they committed to an additional $75 billion repo and upping the overnight repos from $120 billion to $150 billion. The question then becomes, is this going to be enough? Will this provide the liquidity? That's why you have to stay tuned and really pay attention to what's going on in the repo market next week. And I can assure you, I will be covering that. So stay tuned.
You can follow his channel. You can definitely listen to the man. He does a ton of videos.
How does that really pertain to a dollar collapse? I mean, I get it. We need to watch out for yield spiking, and if the Fed has to come in here with more
quantitative tightening, what they did in 10 months, they undid it in 9 weeks.
But I don't get how that
They undid it in 9 weeks.
going down. Insert Luke Groman. Step number 2. Luke Groman outlines a brilliant argument for the dollar collapse on the last episode of the Macro Voices.
You guys need to listen to that. That's where Luke came up with this.
It all starts with understanding how governments and financial institutions have to continue to roll over their debt. To understand that better, let's go back to that Bloomberg article. In finance, a lack of liquidity kills you quick, says Perry Merling, a Boston University economics professor who co-authored a 2013 paper with Pozar. How do you not get killed by liquidity? By rolling it over. By saying, I can't make the payment today, I'll make it tomorrow.
And if you heard that, it's from the All Lost podcast where he said it as well.
More reasons why in just a moment. But let's remember that the Fed funds rate, their target range, right now is between 1.5% and 1.75%. But the repo rate spiked in September up to 10%. This tells us that if the Fed wasn't intervening into that repo market every single night by the tune of $120 plus billion, that's what the rate still would be. And the repo rate affects the Fed funds rate. Let's go to this Reuters article that shows us back in mid-September when that repo rate spiked, so did the Fed funds rate. The Fed funds rate affects the amount of interest paid on corporate debt, and that affects the interest rate that the federal government has to pay on all of those short-term T-bills that they're rolling over. All of these interest rates apply directly to the stock market and the housing market, meaning the higher these interest rates go, the lower the stock market goes and the housing market. So if the rates right now are at 1.5%, what would that do to the stock market and the housing market if rates went to their natural level, which is 10% in the repo market? This, among many other things, is what Luke Groman points out in that Macro Voices podcast. But let's remember, if the stock market goes down and the housing market goes down, so do tax receipts. Editor, let's throw up that chart that shows there's a direct correlation, not necessarily
directly from the Fed
rates, but more so to the stock market and the housing market. The lower the stock market goes, the lower tax receipts go, meaning the money that the government needs to fund itself. Let's shelf that for a moment and focus more on the government and how they roll over their debt short term and how that plays in to the bigger picture. Luke Groman pointed out that in fiscal 2019, the federal government had to issue $11 trillion in new debt. And you may say, well, that seems impossible when we only have $23 trillion in debt. But you've got to remember that a lot of their debt came due and they have to roll it over because, of course, they can't pay it.
He does a better job explaining than Peter Schiff.
With how much debt they have to issue for the deficit, that's what brings us to this $11 trillion issued. Of the $11 trillion, 71% was issued in T-bills with a maturity of 6 months or less. What that means is that the government, within the next 6 months, will have to roll over $7+ trillion, and they will be at the mercy of whatever the Fed funds rate and the repo market rate is at the time when they have to roll over that debt. Are you starting to connect the dots? This brings us to another doom vortex. The doom vortex would work like this. The Fed funds rate goes from 1.5% and it approaches what the real repo market rate should be, and that's 10%. That would implode the corporate bond market, which would implode the stock market, which would implode tax receipts. A lot lower tax receipts plus higher interest rates would mean that the government, when it goes to roll over that debt and issue more short-term treasury bills, the issuance would have to go from $7 trillion, Luke Groman says even up to $10 trillion. Because they have to issue more debt, that means that the people who are lending them money would see more of an inflation risk, which would do what? Would drive interest rates even higher.
And we can't have higher interest rates.
Groman described this in his own words. Let's cut to a clip from the Macro Voices podcast.
What you have is the U.S. government effectively funding itself in short-term funding markets. So if the Fed just let markets work like Powell said he wanted to do, repo would go back to 10% or more, and the U.S. government would need to roll $6 trillion or so in the next 6 months at 10% plus. And the U.S. government cannot afford to roll $6 trillion at 10% plus, especially since at 10% plus, the highly financialized U.S. economy would collapse. So the financing needs would non-linearly go from 6 trillion to 8 trillion to 10 trillion over the next 6 months as tax receipts.
Oh, that debt.
And mortgages would be at 12% plus, so you have housing collapsing. Banking system would likely quickly follow. Corporate debt issuance would grind to a halt with repo at 10%. They can't afford to roll any of that stuff at 10% plus. So record U.S. corporate debt issuance would begin defaulting, which, with corporate leverage as high as it is, could easily quickly wipe out significant portions, if not the majority, of the equity market cap of the United States and the world. And remember, as we've noted multiple times, in the U.S., equity market cap's 160% of GDP, and net capital gains plus taxable IRA distributions alone are around 200% of annual growth in personal consumption expenditures, which itself is 2/3 of GDP. So, in plain English, there's no economy in the U.S. or the world if U.S. stocks crash. And that's not hyperbole, that's just sixth grade math.
What you may be thinking now is, yes, George, but the Fed would never allow that to happen. They'll come in and print money to make sure that those rates stay at 1.5.
And that's what Peter Schiff has been saying as well.
Be right, and that brings us to the dollar collapse that we'll get into right now. Step number 3, Luke Groman's dollar collapse endgame. He believes that the Federal Reserve will come in and print as much money as they need to make sure that they keep the rates down, not only in the repo market, but every other market as well. He references a speech by Ben Bernanke in 2002 where he suggested that in the future, if we have this type of problem, that the United States could just fix interest rates, meaning on the 3-month, the 1 year, the 10 year, the 30 year, they would have a target rate and they would not allow interest rates to go above that.
Think how nuts that is.
They would print to buy
Inflation. That's what I heard.
every single T-bill necessary to make sure that that happens. That would expand the Federal Reserve balance sheet from 4 trillion to 6 trillion to 10 trillion to to $20 trillion. It would be the Buzz Lightyear balance sheet to infinity and beyond. This would put tremendous amount of pressure on the dollar, and it would have to go down in order for the Fed to stop the infinity and beyond balance sheet. Why is that? Because at a certain point, once the dollar gets down low enough, other countries, foreign entities, will be able to afford to come in and actually buy treasuries. Right now, they can't buy that many treasuries because the dollar is so high. Let's use Mexico and the United States as an example. Right now, the peso is 19 to 1, meaning you need 19 Mexican pesos to buy one US dollar. Well,
All right, guys, let me take a quick break.
Dollar went down far enough to where you only needed one Mexican peso to buy one United States dollar, then the government of that country, and it could be Mexico, it could be any country, would then be able to afford to come in and buy a lot more treasuries than they are right now. This would put a bid on the treasuries, and that would decrease the amount of money that the Fed would have to print to keep those interest rates low. And you say, well, George, we could do Japan. Japan's been doing it forever. But you have to look at demand for a specific government's debt. And in the case of Japan, they have a 30% savings rate.
That's what I touched on as well.
So they don't need as much external demand for their debt because they can finance it internally, meaning their own population can buy that debt. Where in the United States,
you're a patriot.
Our savings rate is maybe 3 or 4%, so we just cannot fund that internally. We have to go externally, and that's what puts us at the mercy of all of these countries and buyers outside of the United States. This is the end game that Luke Gromen sees. Basically, the Fed has to expand its balance sheet until it can push the dollar down far enough to where it's attractive for foreign entities to buy our debt. So next week is the Y2K moment. Make sure.
And the thing is that, how do we know that for sure that they're going to come in and buy it? At what point are they going to buy it? That's what I've been talking about. That's what I've been saying for what, almost 2 years? But like I said, I barely got along all this a year ago. It's the summer. So that's what I've been talking about. I've been connecting the dots, but he does it way better. These last two videos that I showed you connect the dots all the way through.
Sure, you're watching on December 31st, and we'll see if the Fed has to come in on a permanent basis and inject even more liquidity into the market. We'll see if Zoltan is right.
And that's the thing. Well, we will see if Zoltan is right. So right now, gold is trading at what? Minus 10 cents. So quickly want to touch on a few articles. My son just got back, so I'm gonna let him pass by because I'm in the living room, just so you know. So let me go ahead and do that. Sorry, guys. I thought I heard them. No, she's still picking them up. Which is treasuries, right? You saw what they are. You know how they work. You have an understanding of how they work. a hard time to fall in 2020. Optimism rises. So this is from Bloomberg. You try and get them from Bloomberg. The terminals are exceptional. I usually get a lot of news from Bloomberg. Like I said, I wake up in the morning and that's the first thing I listen to through iHeartRadio. So I'm reading these, basically all the stuff that I read. I think they can only go down. And then the other thing that when I was reading through, recession gets priced out in a stock market rally for the record books. Right? No one's expecting a recession in 2020 now. Everyone's expecting in 2021. At the very least, they should be expecting at 6 months in, because they have to roll over all that debt. But we don't know yet, and they haven't told us so. I just quickly want to do this, get through this. I think they are here, and I'm gonna have you guys watch this last 3-minute clip. All right, they're here. Hold on. All right, let's just watch this clip. No, they're passed by already.
Just money everywhere. Keep going. So I want to wear in this case. Yeah, absolutely. In the US? Everywhere. Emerging? Everywhere. This is nothing to do with fundamentals anymore. Right. Fill your boots. What up? 400, 500 billion from the Fed, reverse course, so let's get it right. This time last year, the Fed were tightening mode, all we're going to do QT from QE, let's do all that. Then they don't do that, then they decide the interest rates aren't going up, and then they decide the repo market's collapsing in September, so we decide to start flooding that to make sure, not QE, absolutely not QE, something completely different from QE. And we'll just keep pumping, and we'll just keep pumping, and we'll just keep pumping, because it's worked for the last 8 years.
Yep. Keep buying.
So no, the answer is quite simple. All CTAs have gone along. Most macro.
Look, I would look to trim my Apple. I had Apple.
In London, I know for a fact as long as they can be involved on the floor. Keep going. I mean, until you don't, until the music stops. It is. I'm being incredibly flippant, but for a very good reason. There is no logic to any of this other than chase the gilded lily. It's nuts.
So when do earnings and growth and
Earnings have been super low, dude.
become an issue?
Are they relevant earnings anymore? I don't care. It's not my job. Just buy it. I mean, I hear exactly what you're saying. I think this is very sympathetic. This has nothing to do with fundamentals anymore, and you have to decide if you are someone who enjoys the momentum of the trade. But let's all focus on the central banks. Because the macro noise, you have some China noise there going about ourselves, right? That's mostly inflation, by the way, the problem with pork, which we can probably go into some detail on. Fact of the matter is, China has been the arm of the taste for the last 5 years or 6 years in terms of marginal growth. The US has plugged up. It's done 2%, 2.5% GDP growth, and let's face it, the rest of the world has not done a lot of European development.
Japan and Europe barely contributing as they grey. So we have a year in which earnings
have actually done nothing in the US and markets up 100%. Now, this time last year, I wrote a note quite happily saying, don't bother hibernating, get involved. You ask me a year later where you go, it is now entirely reversed again. We've gone out of tightening mode to loosening mode, immensely loose, with the Fed sitting there saying, rates on hold.
We're going to get looser.
Little sort of repo thing going for a little bit longer. And Trump in the background going, keep going, keep going. Meanwhile, they'll spend the next 12 months telling you how phase 2 of the trade deal, a trade deal I noticed the Chinese haven't even bothered putting into any of their press, let alone putting it in writing, because it doesn't actually mean anything. Sorry, did I say that bit? So let's go. We're just going to keep managing this, because once we've got that trade deal, the whole world will be fine. Not reality. This was slowing down well before this trade deal started being the biggest issue. And how about we've just got a big debt mountain, maybe consumers are a bit tapped out, and it's going to be a bit slower. That's more consistent with perhaps where bonds are, but it certainly isn't consistent with the S&P 500 in every metric except the fiction that is EPS growth linked to the PE being 99th percentile expensive. So I think I've laid out my stall. It's insane, but it's going to carry on because the Fed is now absolutely hot to what they've created, which is a monstrous beast.
Don't fight the Fed.
In the US, I hasten to add.
Don't fight the Fed. Like I said, dude, people are fed up with it because they know this is gonna end horribly. This is gonna end real bad. So we got Monday is gonna be a busy day. We're gonna get some good data, trade balance, the wholesales. We're gonna get all that stuff. 7 o'clock. That's 5:30. And then 7. Pending home sales, for the month of November. Data's manufacturing. We're gonna get some good stuff on it. So Monday's a lot of data is gonna come out. So we're gonna see the pop in gold, if it's gonna go up, or it's gonna decline. Like I said, most of my calls are now moved into the February. So I managed to buy some 2 weeks ago. I'm holding on to them. Don't see them get out until unless like the repo is crazy. The repo doesn't really do anything, but I'm sure it will. Can't wait to wake up and see what's going on in the markets. The other thing I want to bring up is Luke's, the one from the interview, Macro Voices. This is from his Twitter account. It's just them buying gold. Everybody's buying gold. He retweeted it. Central banks are buying gold again. In fact, since 2008, they have bought back more than half the amount they sold between 1965 and 2008, according to, and he clicks on it. But if you look at this, just by doing one click, right? I've always shown you guys the federal balance sheet. Look at that. It's almost like seeing it. It's like at the same time this is going down, it's like boop. So I'm like, what's going on? Like, look at this. That little part. Doop. There's only so much gold out there. So when I saw that, I was like, wow. I just clicking through it, I was like, oh man, this kind of looks like it. So the balance sheet's gonna keep growing. If it goes to 7 trillion, because they have to roll that over, wouldn't be surprising. I mean, they're at 4 something, 4.4. No, we are at. So we need like what, 300 billion to get there. All right. So earnings, there's a bunch this whole week. This next week coming up, there's a bunch of data. The last thing I want to just show you guys quickly. They're still buying. Federal banks are still buying, and they're buying more and more. Something's going on. They know about it. It's easy for them to see. And then this one's a little older. December 23rd, investors have fled the U.S. stock market at a record pace this year. But it's December 4th. That's what I mean by older. I mean, more and more people are going to start fleeing because the writing's on the wall. This is going to end poorly. So the dollar, I don't think is going to go up anymore, especially if they do this year-to-date thing. I think it's going to come down. Things is testing. Every time it's tested, it's come back up. But if they start doing the repo rates, it's done. I mean, the per QE is going to go down. It's going to come down. Oil will be cheaper, which means barrel of oil will go up, emerging markets will go up. Everything else will be way more attractive than the U.S., which is where I'm at. 401k, everything that I have, that's the strategy I've been doing, being contrarian. It's paying off. This year's paid off the most. I'm looking forward to continuing this in year's end. So I hope you guys understood how is it that I thought, obviously George does a way better job of explaining it. And like I've said before, you don't have to be the smartest person in the room. You just have to be the best listener. Wish you the best of trading. Good luck out there. Enjoy your night. Enjoy your weekend.